Hello, everybody. Thanks for joining us back at the Projectworks Podcast, a conversation for high growth consulting leaders about the stuff that keeps us up at night. We have a fantastic topic for you today. We are talking all about exits, selling your consulting firm. And we have a fantastic guest for you today, who I will let Mark intro in just a second. But first of all, welcome to Mark Ortung, our CEO at Projectworks. Hey, Mark, how's it going? How's the day?
Great. How are you doing?
I'm good. I'm great. Thank you. And I will let you do the honors of introducing our very special guest for this podcast, Allen.
Excellent. Well, I'm excited to have Alan rejoin us. He was on, I think, our very first episode on the podcast. So before I came to ProjectWorks, I was CEO of a company called Nexient, and Alan was one of my partners there that really helped us create something special in Nexient. And so he's now CEO of Koniag Capital, and always better dressed than me. So I'll turn it over to Alan to give a little more of an introduction for himself.
Well, thanks, Mark. It's a pleasure to be back and looking forward to adding some value to the audience here wherever we can and talk about an important topic, which is the topic of selling the business. I spent a lot of my time in my career on the sell side, joining founders and executives of consulting businesses, and then building and helping them build and sell and scale a bit over 3 to 5 years, and then helping them sell to either strategics or private equity. I did that a number of times, and also in some of those cases also helped to acquire businesses inside of the acquiring companies once we were inside the larger business, and did that a couple of times as well. And now fully on the buy side, looking under our buy and hold strategy at Koniag Capital, looking to buy businesses under acquisition mandates that we have to serve our shareholders. And at Koniag, we're an Alaska Native corporation. We represent 4,600 Alutiiq Natives in Alaska. They're our shareholders, and they receive distributions from us every year from building great businesses that generate net profits. And so our mandates are to buy technology services businesses, primarily focused in different sectors that serve the commercial and SLED markets. And it's been a lot of fun being on the team here. We have access to $500 million in dry powder to buy and hold these businesses and help them grow once we acquire them. And my experience in helping on the founder side and in building these businesses comes into play now in this role, where we can help scale these businesses once we acquire them. So it's a nice combination. It's great to be here again.
Yeah, awesome intro, and you can see why we wanted to have Alan back. Just great experience and a great perspective from the current role.
Yeah, absolutely. Thank you for joining us, Allen. I'm really excited to get into this convo. And I think why people would have joined today, I hope, and I think there might be a poll coming up today around if someone valued your firm, because I think really to get clear again on what we're talking about today is about how buyers actually value consulting firms and how to build with better exits in mind. I think it wouldn't be brave to say most people who are working really hard building a consulting firm have an idea of what would happen if I made an exit one day. And I think quite often you're so hardworking in the business, on the business, that it can be really take a lot of effort to take stock and pause and really think about those metrics, because they don't happen overnight, and being really clear on where it should be you're putting your effort there. So we've put up a poll here. It'd be really cool to hear what everyone who's tuning in thinks about this. Is if someone valued your firm tomorrow, what would worry you most? So if suddenly you got a call, hey, we're really interested in buying your firm, can we check some stats out? What would be the one thing in the back of your mind that might be like, oh, I wish I'd worked on that a little bit sooner? I'm sure everyone has something that, as I said, keeps them up at night. So as we have those kind of votes roll in, just to set the scene on what we would like to talk about today and how we will structure the chat, I'm going to start off by asking Allen and Mark a little bit of the overall market and current climate. It's 2026. There's lots of changes. Things are moving extremely fast. I'm sure what was potentially relevant 3-5 years ago is different to today. So it might be nice to dig into that. And then in the second part, we are really going to dig into some more fine details about how firms are valued. So hopefully our listeners and watchers can come away with some really concrete outcomes there. Great. I can see that the results of the poll have come in. Interesting number, the highest ranked at 30% was too much depends on the founder. Yeah, I can see Alan nodding at that, and Mark, yep.
Yeah.
And that's been an interesting topic that's come up consistently actually across our different topics on this podcast. Another couple that were high up there is profitability. That's an interesting one. I talked to lots of customers around profitability on a project overall, on a client base. Another couple here, unclear future revenue, too much work tied to a few clients. I think the others were around there, growth rate, all of those sorts of things. So thank you for everyone's input there. Good to get that context. But I'd like to kick off with this. Mark and Alan, whoever can jump in first. Really, I'd like to start by, before we get into that valuation, can you give us a little bit of the lay of the land as you see it at the moment? What do you think has changed at M&A for services firms over the last few years? What do you think is happening in that space?
You bet. Mark, you want me to go first on that, or
go for it.
Sure. So it's a great question, Dominique, and thank you for setting it up. And that the survey was profoundly accurate in terms of the things to be concerned about when you're selling your business. That was an astute set of survey results for sure, and we can certainly talk about some of those. But overall, I think the AI is a game changer, right? In terms of the impact in the market, you just can't not talk about it in terms of. First of all, there's pricing compression in the market. So clients that we serve are expecting AI efficiencies in the way that we provide those services in your service business. You simply must do a better job, more efficient job of providing the service, which creates pricing pressure and forces more efficiency in the rest of the business. And certainly, if you're not accounting for that, you're behind. The second thing is that in the M&A world, that 2021, free money is gone. We've known that for some time. I still hear some people quoting numbers about the value of their business from when they received information in 2021, and accepting that those days are gone is an important aspect of a founder's need to understand what their business is worth, I think, many times. And yet, what's also true is that it's extremely competitive out there for great assets. And so the kind of multiples that we were aware of when Mark and I were working together and selling the business that we worked so hard to build and sell back then, some of those multiples are actually coming back, but it's for very, very specific companies that have a focused niche and are growing fast and ring all the bells. Back then, you could get by with some higher expense rates inside of your G&A. You could get by with maybe a little bit of founder dependence and still get a very high multiple. Now everything has to be really knocked down, including customer concentration and lack of founder dependence, to really get that. But there's so much good competition out there, and a lot of money on that dry powder out there, that companies are starting to get back in some cases to that 17, 18x of EBITDA. But it's much more rare than it used to be back in 2021. What do you think, Mark?
Yeah, I agree with what you said. What I think is always true is if you can really differentiate your firm, it creates the most value, but I think it's gotten harder and harder to do. Like, the world is moving so fast. Even if you find a great niche where you are differentiated, what used to be maybe a 2-year window or a 3-year window that you could maintain your differentiation might be a 6-month window. And so just maybe the getting to differentiation and then proving you can keep reinventing yourself in this crazy fast curve we're all riding on would be the thing that would get you to those multiples you talked about, right? Where you can really show you're ahead of the curve, you're ahead of what's going on with technology and how it's getting applied and how it's really working with your clients. So yeah, I think that's the most valuable thing, but also the hardest thing to go do. So it's very difficult.
Yeah, exactly right.
Alan, I'm going to ask straight away, because I'm sure that people who are watching or listening are thinking this. In your intro, you talked about talking to lots of different firms. I assume that the volume of firms you're talking to who are interested in selling or being acquired, what firms are selling? Like, what are you seeing that you would be some of those standout
Hmm.
traits?
Well, from our perspective, we know that we need to look at upwards of 250 to 300 companies to buy one. So that's how we think about it, and that's not abnormal in the industry to really have to get out there and find the right cultural fit, the hole you're trying to fill in your own portfolio businesses. For us, we have again three distinct acquisition mandates, and so that leads to a lot of it. Then you have to really get into the strong management team and the founder dependence and the customer concentration, all the way down to an agreeable pricing structure, and so on. And so it really takes a lot of hustle in the market. And so we use buy-side bankers to help us with that, and we've had mixed success with that. And we do a lot of organic outreach, and that's a lot of what I do. To answer your question directly, Dominique, the glib answer is that all these companies can sell for the right price, and that's largely true. We've run across a couple of companies that simply can't get sold because they just have too much debt, and other just too much difficulty, and mostly on the balance sheet, that prevents them from being able to sell their business. And so cleaning up the balance sheet through more discipline on the P&L takes a long time for some of these businesses. But other than that, we're finding that any business can be sold right now, and there's a pocket somewhere out there for your business, whether it's inside of a private equity roll-up or inside of a strategic that needs to fill a hole, or inside of a family office like ours, where we create space for founders and businesses to run a little bit more nimbly inside of a broader structure over the long haul. There's a spot for you, and yet the ones that are selling for the price a founder might want fit into the category that Mark was just talking about earlier. So if you're willing to compromise a bit on what you really want to make, and your business may not be perfectly suited in the market, I think you can sell your business to anybody, and there's a lot of dry powder out there to spend money on your business.
Yeah, cool. I love that. And I think, and I ask you to talk a little bit to this, Mark. When we've been speaking about this a lot and speaking with customers, I think something that people talk about is like, well, when should I start worrying about this? When should I start thinking about this? Is it, should I, like, now, if I want to sell in a year's time, or should I be thinking of this 3 years ahead? People are like, should I be talking about this to people? What are the things that, a founder should be understanding or putting in place, even if they're not planning on selling anytime soon?
Yeah. So we sold in 2021. The first inbound M&A discussion I entertained was in 2016. And I probably entertained some every year in between.
Right.
And partly that was me, because I didn't really understand what it would take to sell a company. And I wanted to see what they were asking me for, see if we could produce it, see if we look good. Like, I wanted to learn. And so yeah, so maybe if you there's one way to answer your question is, how much do you understand about it, and have you done it before? Even if you have done it before, I think you need to be thinking about it at least 2, possibly 3 years ahead of it, because you're going to want to get your processes in order. You're going to want to get your finances in order. There's all these things, like if you can lower your G&A as a percentage of your overall revenue, that really helps. If you can raise your profit level, it really helps. So, and also sharpening your differentiation is key. So I would say minimum 2 years, probably more likely 3 years ahead, you should be starting to really think about it and work on it.
Yeah, cool. And I just want to acknowledge I've seen some questions coming in the chat, and I will make sure we get to some of those. So please keep them coming in. But just building on that, Allen, from hearing what Mark's saying there, would you say that you think knowing some of those metrics, or knowing your exit sort of off ramps or things, should change the way you build your firm? Like, do you think people should be doing that? And do you see that when you're talking to firms, people who have been more, I guess, strategic about that?
Certainly, the mix of founder-led businesses out there runs the spectrum. Absolutely. One founder we were speaking with recently for a business that we're actually very interested in, we asked him, what are some of the lessons you've learned early on in the process? Because he's got a sell side banker helping him and through a process to get bids. And he said, well, I wish I would have known what EBITDA was. And I wish I would have paid a lot more attention to it now that I understand the entire value of what I'm going to get paid for my business is based on a multiple of EBITDA. And so that's an indication of one end of the spectrum where a person was so focused on building a great business and caring for customers and treating the P&L as a little bit more of an afterthought that they wish they would have done that as one extreme example. However, I do think that as when Mark and I worked together at Nexient, he was always reminding us to build a great business first. And so, yes, thinking about EBITDA, yes, thinking about differentiation, yes, thinking about not being too dependent on one client or two clients, and yes, thinking about scaling beyond the founder in terms of the executive team are all really important to the sale of the business. That's also just a great way to build a business. And so I think it's that combination of recognizing those are really important attributes someday. But I have seen founders who start the business with the intention of selling it. And that's the only intention that they have. And that I don't think that goes very well very often.
And do you think that
Yeah, I would.
Sorry, I was going to say, do you think those are the sorts of things that founders like potentially accidentally limit their options when they're doing those sorts of things? Maybe you want to follow.
I do. I do. Yeah, of course. And well, why is that? It's because the intentionality of serving clients and building a great team has to be the centerpiece. And then if you're not doing that and you're focused only on getting to some other multiple, I think employee attrition and customer attrition goes up as an indicator of not a strong business. And then you end up limiting your options that way. But I don't know. What do you think, Mark?
Yeah, I was going to say, I think that when you sell, you want leverage. So to give yourself leverage, you should have something better to do with your firm than sell it. It's kind of a weird way to think about it. But so when somebody comes at you and says, we're interested in buying, if you can say, well, maybe, but we have this plan. We think over the next 2 years, we're going to grow this much. We're really excited about the business. But we're open to talking. You just get a lot more leverage than if you, for whatever reason, design yourself into a position where you're like, we're going to sell in 2027. Like, I just think there's so many variables you don't control that I wouldn't do that, right? Because you don't know if the market's going to be weird in 2027. You don't know if your differentiation is going to be, there's just all these weird. So back to what you said earlier, build a great business, have something better to do than sell your company so you have an option. And then you can get really great offers, I think. Yeah.
I think that's a really cool way. And I also think that's a very powerful way to explain to the people working in your company. Like I've heard you say this before when we've talked to customers, it's, when people say, are you going to sell? What are you going to do? It's like, well, our plan is to build a great company. And we're going to be really laser focused on these metrics that make a great company. Now, that also makes it a great company to potentially buy, because that option then becomes available. But you're so right. It doesn't paint you into a corner that is your only option. So I think they can go hand in hand. Now, I want to switch a little bit away from the market to get into some more of the details of how firms are valued, so people can come away with some really sort of concrete, clear ways that they can take back into their business. And I want to start off a little bit with some of the questions. There's a couple of questions in the chat. I don't know if you've both, while you've been chatting, had a chance to read through them. But there's a similar theme to both these questions around here, which is essentially professional services firms transitioning from sort of staffing billable hours model into, say, a tech-enabled services firm. The second question is around, low profitability today, but undergoing a major AI-led changes to the operating model. And I don't think this is uncommon. I think most people that are watching this, there's a real, well, I feel anyway, around AI and how we optimize. It should be people and processes. So what can you do to get the computers doing the computer jobs and the humans doing the human jobs, and how do you bring that together? But that is quite different to how firms have potentially been valued if you're getting more optimization around there. So I guess a question there, Alan, are you seeing that across the portfolio of customers you're working with? And how does that change how firms are valued or built to be valued?
Well, yeah, it's a good question, Dominique. And if I read the question accurately, it looks like the question is, how would you value a business now that's anticipating those efficiencies in 6 months? And my best recommendation there would be wait until you achieve those efficiencies to get a valuation in the market, because the rest of it becomes speculative, I think, unless you're, to Mark's point, unless you lack leverage and you need to sell your business right now. I'd wait until you are able to achieve those efficiencies and demonstrate them in the market. You're going to get a lot more for your business than asking an investor to speculate on that with you. However, if we're banking on that, we're gonna likely tie that a future value of the efficiencies that are anticipated in either an earnout, or we're going to put that in something we're not going to pay cash up for up front. So we would buy 70% of your business at one EBITDA multiple, and then put into the purchase agreement that we would pay you for the rest of your business on a higher multiple, assuming those efficiencies are achieved. So that's an interesting way of asking the question, and I hope that's a helpful answer in terms of what we would do, at least at Koniag Capital, in valuing that business to de-risk it for us.
I have a question for you, Alan. If I'm the person asking the question, and so say I can, in 6 months, I drive efficiencies. Now my EBIT's better, or my EBITDA is better. How long do I have to operate that way to get credit? And if I do 4 quarters of great results, am I good, or do I need 6 quarters? Like how long until I get the check mark that you're more willing to pay up for it?
Yeah, I think 6 months in this market, because of that's enough proof. 2 quarters really, in my view, is enough proof that you've gotten there, and that it's in the new DNA of operating a business. I think that it shows signs that maybe they bought Projectworks software to get some efficiency, or some other PSA tool to get some efficiency in their business using AI, and they're using AI to get efficiency in their back office with finance in particular, for all the automation upside. Once it's in there, it's not going to go away, is what I would say. And that 6 months is the window. And then it allows us to focus on the rest of it, which is, what's your gross margin profile? What's your customer concentration? Those kind of other things that help us really peak value for paying founders really well for their business, which we're not afraid to do. We just bought a business for 2x revenue because it was strategic to us. And we didn't focus on a multiple of EBITDA in that case. But that's my answer, is 6 months.
Follow-up question here. How important, Alan, when you're looking at the moment, which I imagine has changed even in the last 4 months, let alone 12 months, for AI within an organization, how is it to be seen that a consultancy is embracing that to improve their efficiencies? Or is it really just the efficiencies around there that you're looking at? Like, would you see where I'm going? Like, would you, a company that doesn't have any AI, has not sort of started that journey, but still has great efficiencies, or would you be more interested in one that has taken the leap and done some?
Yeah, that's a very good question, and it sort of depends on what they want for their business, right? Like, if what we are looking for in our situation is businesses that do adopt AI in serving our customers. That just has to be the case. And if we don't see any evidence of that, we might look at buying it, but it wouldn't be for the same price. It would not be, because then we have to help them do that, and help them figure that out and how to bring that to the market. And we would want to pay a lower valuation for that business. And so, to Mark's point, if they have leverage and they have time, they should wait till they figure that out, and then bring it to market, or be willing to accept a lower price. For us, what I'm also starting to care about, Dominique, which is new, and something that I think a lot of investors are starting to look for in a significant way, is AI efficiency in the back office, because that is something that isn't fully proven, but we know is there. And if a customer has started to do that, back to the earlier question, for 6 months, then that's very, very helpful to us and we know they're on solid ground to make the kind of pivots that Mark was talking about earlier once we buy them. Because the market's changing so fast, if they have streamlined the back office using AI, they have more room in the P&L to maneuver based on market conditions. And I think that maneuverability based on market conditions, as Mark pointed out so well earlier, is critical. Some people describe it as we're going from horses to cars. So you need to be in the transportation business, not the horse or the car business. And that is very true right now of professional services.
It's a great answer. Thank you, Allen. I think that was a really great takeaway for everyone, I'm sure, that's listening here. Okay, I'm going to pivot a little bit to numbers, the number we get to. So, Mark, I'm going to throw this at you. You've been talking to some people, and then it would be great to get Allen's point of view. How do you think founders arrive at a number in their head? How do you think that they think about what their business is worth? And then Allen would like to hear, I guess how is it different how a buyer would arrive at a number? So you first, Mark. How do you think they come?
Yeah, most of the founders I talk to that have not really sort of been through the process and talked to bankers and really gotten themselves up the learning curve yet sort of think about it as a multiple of revenue. They often say 1x, 2x, 3x revenue. And while that often is where they land, it's not because it's time of multiple of revenue typically. I think typically the deals are done more on the EBITDA and the growth and other things, but they usually it seems like, oh, I'll get 2x my revenue. Seems to be like how they're thinking about it. And now we can have Alan tell me why that's wrong, like why that's not why he would how he would get to the
I agree
number.
with you, Mark. I think often talking to people, that's a number they've worked out from talking to other people. So if you've been talking to other founders, other people that have exited, it's probably a much quicker conversation to say, what was your revenue and what did you sell for, rather than, what were all of these other metrics that you dug into, and then what did you sell for? It's an easier takeaway if you're just talking to someone over a lunch. But Allen, hit us with what you think is actually the reason.
Yeah, I mean, well, I certainly think that most investors are focused on a multiple of EBITDA, with the rare exception of a multiple of revenue when the EBIT is not there, if the business has a strong enough differentiation and adds value. So when, as an investor, when a company has taken all of their potential profit and put it into differentiation, and that differentiation is working and it matters to the buyer, then we talk about a multiple of revenue to get everybody comfortable, because otherwise I don't have a basis on which to bring something to the investment committee that I report to. So, because, there are some companies that very, very little profit or no profit to sustain their business, because they are investing in the right ways, not digging out of a hole, but investing in the right ways in their business. And they have differentiation that we're willing to pay a multiple of revenue for. But that's the only time in our lingo these days. Otherwise, it has to be EBITDA based or adjusted EBITDA. And so a lot of the conversation in the details of the LOI process, the letter of intent process, and or the diligence process is, what can we add back to EBITDA so that we can bring up the EBITDA number to improve your result as a seller. And those things are like, can we get back office savings by centralizing the back office, or into one common back office, or can we take out some of the founder expense and founder distributions, or some of those things to fully reconcile the P&L in a way that boosts that EBITDA number for the long haul in a structural way. Sometimes people try to get really creative and clever about things that they want to add back to EBITDA that just don't belong there. That we have to persuade the seller that actually needs to be in the business to sustain the business, and so we don't get to pull that out. Sales commissions need to stay sales commissions. We're still going to pay sales commissions. That's not a one-time expense we get to pull out. So those are some of the things that I might add to Mark's answer. I do think founders sometimes get a number in their heads because of extreme stories. So people love drama and people love stories. And so they'll hear about the valuation that Mark and I were able to achieve in a rare time in the market for selling Nexient, and they'll hold on to that for their business as an extreme story. Or they'll hear about some horror story where a founder buddy of theirs got ripped off and didn't get paid enough. And so those are the extreme stories where oftentimes the healthy answer is somewhere in the middle for everybody.
Right. Now, getting into some nitty-gritty lists, what are some other things that buyers are valuing in services firms? We've spoken about differentiation, we've spoken about EBIT. What are some other elements that if you were talking to a founder and they were like, here are some things that you should have on your dashboard, front of mind, in your strategic plan? Mark, maybe what were some of the things that come to mind when you have gone through this that were just all consuming, you had laser focus on pre-sale?
Yeah, I think, do you have a machine? So, do you have, if these three important people leave your company, is your company going to keep going? Is it going to still be successful? Or is your company like completely dependent on these three people? I think that's probably one of the most critical, and it's difficult. When we were looking at it, people would give you credit at a certain revenue level. Like if you hit 100 million in revenue, it's very likely you built a machine, so they would give you credit. But I don't know if you're 10 or 20 million, how you kind of prove that. I don't know, Alan, if you guys look at that, but yeah, how dependent are we on the founders or on the leadership?
Yeah, we try to look at that, and I think it's a great point. Very often the businesses that we end up looking at do have those kind of dependencies inside of them because they're the lingo in our world is subscale, that you just haven't achieved even at sometimes even at 5 million in net profit, which on a 10% profit business, that's a pretty good sized business. And yet
Yeah.
there's still going to be some level of team dependence. And so then what we do is we focus on how do we have sources of talent to replace those people? Can we find, if they were to choose to leave, how do we augment that in our plan through recruiting or knowledge of the industry to find great people to augment that team? Because we have to be able to do that knowing there's a risk that people will leave. And that there's sometimes founder risk, but oftentimes it's just a very strong chief revenue officer or a really strong salesperson in the team or a head of delivery that wrote a book or something like that is profound in the market, and they could take their book and go someplace else. So those are the kind of things that we think a lot about in terms of mitigating that, knowing that it's almost always going to be a risk.
Yeah, I agree. And I think one of the points here we have, or I have on my notes here, is talking about like factors that often move that multiple up and down. So there's things that you should be really focused on that if you are in a situation where someone takes an interest to buy your firm, that you need to have that ready to go. These are the questions that they're going to start asking, and you'd need to be able to answer.
Yeah.
And then there's other ones that like what move those up and down. Like, it's one thing to have the answer, but what's going to move the needle? And one of the things sitting in a chief customer officer role, being very customer focused, is customers. So churn and client concentration is a big one. And I think talking to consultancies a lot in our customer base, that's a big one that we can often see when we're working with them within Projectworks as well. How many projects are you doing with this customer? What's your profit margin on there? We've spoken in previous conversations, Mark and I, that often maybe your highest revenue customer might not be your most profitable. That's really high decisions. How do you keep those customers with churn and keep them very happy, but also are they actually profitable? So that's something that comes to mind that I have often personally been in discussions with and founders and leaders and bosses on how that is going in my area of the business. But what are some other areas that can quickly turn to have a sort of positive or potentially negative effect on a sale?
You want to
I think
go
that was
on?
for you, Mark. You want me to take
Okay.
it? I thought that was for
Happy
you
to take
first.
it.
Yeah.
Yeah. So yeah, I would definitely agree that longevity of clients, if you can prove that. So if you have a client that's been with you 5 years, 7 years, and I would say your ability to expand clients. And so one of the things that we did at Nexient was we would try to get a client and be their partner forever. We didn't want to ever be out if we could. And we would try to get them to differing levels of scale. So one was like trying to get a client that would spend 5 million a year with us. The next was trying to get a client at 10 million a year. The first time we hit each of those milestones with a client was many, many years in the making. And then we were able to get it to happen a second time, a third time, a fourth time. And the cycle time from new client to 5 million and new client to 10 million was dramatically shorter, like maybe a quarter of the time, the last time we did it versus the first time we did it. So there's like this, we're showing that we're not only are we keeping clients and we're expanding really well in clients, but we're getting better at it. Like we're getting better at how to pitch who we are and what value we have. And this is a lot of the work that Alan did, was getting in and in the beginning, we were so unknown that it was everything we got was like, we're going to give you this one weird project in the corner. Nobody's ever succeeded at it. Good luck. If you succeed, like you get to keep going, right? And we struggled with that for 6 months. By the end, people knew who we were. They were willing to give us something a little meatier. And so, yeah, but I think that demonstration of improvement of the core
Yeah.
management of your clients and how they value what you're offering.
Mm. Yeah, that is true. It's a great answer. I would augment that only in really one way that I can think of, on top of what you've already mentioned, Dominique. You hit the core, right? But I do think that the best, back to your point, Mark, machines are also adding 10 to 20% of their revenue every year in new clients to protect the
Hmm.
downside risk of any fickleness of an existing client, because we know that buyers are fickle, clients are fickle, and they might change their minds or go broke tomorrow in ways that we simply can't control. No matter how good we
Yeah.
are, they might give us a 10 out of 10 rating all day long, but they're still done with us for some other reason. CIO gets fired, a new CIO comes in and brings in their pals. Who knows? So being able to, the real machines are able to add 10 to 20% of their revenue every year through new logos. And then, to your point, expand at those logos while sustaining some semblance of the existing business and demonstrate that those are happy long-term customers who are going to keep buying for
Yeah.
the most part, right? So I think that's
Yeah,
a really
actually,
important dimension. Yeah.
in an interesting way, like demonstrating growth, even though you have little blips in your portfolio, is pretty critical. Like that would have you're always one email away from like losing a
Right.
client. You just, for whatever random
Right.
reason, as you said, like somebody gets laid off,
Right.
somebody quits, whatever. Like, um,
Right.
and so if
Right.
and that just it just will happen. So if you're continuing to grow because you've built a good enough pipeline to do that, I think that's a huge sign of strength. Um,
Yeah, that's going to really get you a peak valuation, along with the other factors we mentioned around differentiation, um,
yeah,
and a healthy, efficient business around using AI for sure.
yeah,
I have a few things here around next steps. So, what can we actually do? What can listeners and watchers do when they're, coming away, taking this back into their business? One of the points that we had is, if a founder is listening and thinking, I have no idea what my firm is worth, this is great feedback of what I should be focusing on, but I'm not really sure. I believe there will be a calculator link shared in the chat. Oh, there we go. Thank you, Jacob. In there. We've put together a calculator that we hope will be really useful for firms and organizations looking at that. Any other tidbits, Alan, on how people could calculate that or think about that, if you were going to give a quick back of the napkin idea of how people should start thinking?
To be careful not to alienate anybody on either side of the equation when I answer the question, but in general, for a healthy business, if I'm thinking of in our category that we're looking for, 8, 10, 12 times EBITDA are healthy expectations for most consulting businesses that have achieved some level of good or greatness as a part of their business, knowing that no business is perfect. And if with rare stories still happening today about that level at 15 times EBITDA, they are out there. But it has to ring every bell of what Mark and I have talked about today, probably over years, because there is so much. And somebody asked in the chat what dry powder is. That just means money. It just means there's trillions of dollars sitting out there waiting to be invested, or as they say, put money to work. whether it's private equity or strategics or family offices like the one I work for. There's a lot of money out there ready to be invested. That's what dry powder is. And people will pay a premium for all of those aspects that we described, but at that higher multiple. But if you're sitting on a VAR plus managed services business, value add reseller of hardware or something like that, the multiples are going to be closer to that 5 or 6x EBITDA, just because those are more commoditized businesses. So that's more of an example of differentiation. But I hope that helps.
I'm sure it will. Thank you very much, Allen. One other point here, I said for any firm founders or leaders listening who are really serious about planning their exit, where can they go next? I think there might be another link in the chat here. I know Mark has been very generous linking with his time. So if you want to talk to someone who's been through it, if you want to connect with someone there, both Allen, Mark, and myself are all available on LinkedIn. Please connect with us and reach out. That's what it's all about. We love having these chats. And I wanted to hand to the two of you to think about what conversations founders should be having with their leadership team after this episode. So, should exit strategies be communicated? And I'll start off with my point of view there of being in leadership teams where exits have been worked towards and been successful in some places. I think having a really strong leadership team who are really clear on the goals to make a great company, as we spoke about earlier. I think being really clear with the leadership team that exit could be on the table, but the truth is there are so many steps to go through before we get there. That shouldn't be the focus or the worry or all around that. Often it's like, well, should we be, how do you communicate that in an organization? I think what you do is just be really clear on the metrics that matter, the things you should be focused on, the things you're going to hold yourself accountable as an executive or leadership team to focus on, and just get really laser focused at those. And then your options all become options. So that would be my view. Over to Mark first, and then Allen on what do you think founders should be having in those conversations with their leadership teams? Coming away.
Yeah, well, I think you said it really well, Dominique. So he makes it making it a little challenging for us. But what I would add on top of that is,
right.
and so we're really going to squeeze Allen here. But yeah, what I would add on top of that is sort of as a leadership team, what impact do you want to have? So you've got a company, hopefully it's a great company, it's a great platform. You've got clients who are engaging with you, and you're making a dent in the world, right? You're having an impact. So what more do you want to accomplish, or what more do you want your firm to be able to help the world do? And I think that's another way to think about it is sort of, why you set out to do this in the first place. Have you checked all the boxes, or are there still ones you and the team really aspire to? And put write them down and try to go make them happen.
Yeah, I think that's a great ad. I think that your speech, Mark, about leverage is critical. And then I think it becomes, once you have leverage, I think very often people do forget about cultural fit. I hear too many stories of founders who have sold their business to an investor, thinking that investor was going to dump money into their business and help them grow without being really clear about that up front and managing those expectations together. And then getting maybe over-rotated on the check they're going to get cut on the day of close, and then spending 2 or 3 years of miserable in an earn-out period or something like that. And that misery is long suffering. That's not an easy road. And so I would really want you to think about having that leverage that Mark talked about, so that you can be choosy about cultural fit, but you're signing yourself and your team up for a period of time afterwards. Because it might feel great when the money hits your bank account, but that's a short-lived period of enjoyment for the 3 year, 5 years you're faced with after that, if you don't find good culture fit.
That's such a good point to finish on, Allen, because I think there'll be lots of founders and leaders listening to this that are really putting their heart, soul, blood, sweat, and tears into building a business surrounded by really good people. So I think that's a fantastic note to end on. Thank you very much, Allen, for being so generous with your time. There was some really good insights there. As I mentioned, you can find us all on LinkedIn. We like making new friends, so please don't hesitate to connect. And make sure you subscribe to the Projectworks podcast on Spotify, Apple Podcasts, or YouTube. And we will be back in 2 weeks' time. It's going to be be a good one. We're going to share some really surprising Projectworks data behind firms that grow twice as fast and have 50% stronger margins. Some pretty cool stuff there. So have a great week, everybody. And in 2 weeks, we'll be back. See you then.